Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures pulling back this morning after the S&P 500 closed at a new record high as investors digest everything from earnings to tariffs to jobless claims, which came in higher than investors expected. On the trade front, President Trump telling reporters it would be possible to reach a new deal with China, signaling he's open to preventing a trade war between the world's two biggest economies.
Plus, Walmart falling this morning. The retail giant's profit forecast coming in lower than expected for the full year, suggesting that the uncertain economic environment is hitting the world's largest retailer. The company expecting overall net sales growth of up to 4% for the year. That would be lower than last year's 5% growth.
And Palantir shares are under pressure as the Department of Defense plans to reduce military spending by 8% over the next 5 years. Analysts are mixed about the impact this could have on the software company's business. Meanwhile, the stock also falling on reports CEO Alex Karp has adopted a new stock trading plan. Well, U.S. stock futures are lower this morning. The downward pressure, though, context here, comes after the S&P 500 reached its second straight record high. Yesterday, we saw that, and ultimately, as we're continuing to look at some of the fractional declines here during the day, it still has been a sign of a persistent and resilient market, at least for the S&P 500, with these new record highs, despite and moving through some of the tariff talk that has certainly ramped up over the past week and change.
Yeah, Brad, what's interesting to me is very much the market once again kind of shrugging off any sort of development when it comes to tariffs. And I think that's very much just a reflection of a lot of that uncertainty coming out of Washington, kind of this whiplash that seems to be a headline-driven sort of mentality here over the last several weeks. So not necessarily a buy-in yet here from Wall Street, which I don't think comes as a big surprise. To me, also, the other thing that's standing out this morning is the weakening econ data that we are starting to get. When you take a look at jobless claims coming in above expectations, when you take a look at the Philly Fed survey, also offering some evidence there of slowing activity, and coupling that with some of the other weakish economic readings that we've gotten, and had inflation coming in hotter than expected just last week. Of course, that is becoming more of a focus here for investors going forward. The impact that is going to have, though, on the broader market, obviously, is still a big question, whether or not it is enough to halt some of the recent gains that we've seen.
Yeah, absolutely. As we're continuing to track some of the pressure this morning here, of course, it does come with the backdrop of some of the earnings as well that had come out this morning, which we're about to get to. But all of this amid an earnings season where the forecasts, as we've been discussing with some of our guests over the course of this week and the entirety of earnings season, they were looking for some of the earnings forecasts to be revised. We've got a lot of those revisions here, and I think that's exactly what investors are also trying to parse through here. How much of that pressure is on the front end of this year and the chop and volatility? Then once we get towards the back half of this year, is it an easier environment to navigate? UBS has been quite persistent with some of their calls, saying a rise that they're anticipating. Even despite, I think their words were, even despite tariffs, they were still looking for gains. But that volatility is something that we've heard pretty much across institutional firms.
Yeah, and I think the question also is, where is that leadership going to come from if we do continue to see this momentum to the upside? Obviously, as you take a look at the performance, the year-to-date gains, big tech isn't as big of a driver as it has been over the last 2 years. Yes, Meta accounting for much of the gains here for the S&P 500, just in terms of relatively speaking. They are the top contributor to the S&P gains since the start of the year. But when you take a look at those top 10 contributors, and something we've been focusing on here at Yahoo Finance, it's much more than just tech. So I think you can take a look at that, take a look at the broadening, and take it either two ways. One, maybe that points to some opportunity outside the U.S., overseas. That has certainly been a theme that we've been talking about here at Yahoo Finance. But then two, obviously, this is something that we have been waiting for. Something that John Stolfus over at Oppenheimer has talked to us time and time again, that is going to be enough to keep this momentum going in the U.S. market. So again, you do see Wall Street split just on the direction of where the market is headed next.
I didn't want to misquote UBS here. Growth despite tariffs was one of the themes that they had talked about. And to your theme of tech that you were mentioning, they had just mentioned yesterday, the theme of the decade was AI here. That is what's emerged from their chief investment office as the theme of the decade here. So we'll continue continue to track that and the trade here this morning. Switching gears, though, we talked about earnings. Walmart shares, they are on the move for ticker symbol WMT, lower, though, by about 4.7% pre-market after the company's full-year profit forecast fell short of analysts' expectations. The cautious guidance sparking concern that an uncertain economic outlook and tariff backdrop is impacting the historically resilient retailer. Joining us now to break down the latest print, we've got Yahoo Finance's Brooke DePalma. Brooke, I mean, you were just sitting there off camera, still listening into the earnings call.
Just ended.
Okay, all right. So what did we hear?
Yeah, well, tariffs was a focus eventually in the call. It didn't come out right at first, but an analyst did ask about it. Now, we know that Walmart touts that about 2/3 of its products are made, grown, or assembled in the U.S., and so they have a bit of lower exposure compared to their retailer peers, but executives eventually did weigh in on it on the call. Take a listen.
Tariffs are something we've managed for many years, and we'll just continue to manage that. We've got a great team. We know how to do that. We can't predict what will happen in the future, but we can manage it really well. And we're wired to try and save people money. So that'll be our ultimate goal.
We don't have any explicit assumption in our guidance around tariffs. We feel like we'll be able to navigate that. Will it turn out differently than maybe what we expect today? Perhaps. And we feel good about our ability to do that, though.
Something interesting here is that global inventory is up 2.8%. The company did said that they pulled a bit forward around the edges, that they're selling through that stuff quickly, so they're in a good place to kick off February. But in the past, as we've heard from CFO John David Rainey, that cost, that brunt, might eventually have to trickle down to the consumer. And should that happen, should these tariffs go into effect, we also know their private label business could potentially benefit as well.
Yeah, Brooke, one of the big issues and why we're seeing such a decline here in pre-market trading has a lot to do with the guidance and some of the concern that maybe this points to going ahead here for Walmart.
Yeah, that was one of my big top takeaways from the earnings results this morning, was that conservative 2026 guidance or fiscal year 2026 guidance that they had set out. And CFO John David Rainey saying on the call this morning that they're operating in a highly dynamic backdrop for several years, and they expect this year to be no different. Now, they do expect net sales to increase in the range of 3 to 4%. That would be lower than how they ended this recent fiscal year, but he calls it a relatively stable environment, or assuming that it will be that, and acknowledges that there are still uncertainties related to the consumer behavior and global economic and geopolitical conditions. Now, another top takeaway is this strength in the U.S. grocery business that we continue to see, as well as strength from their wholesale retailer, Sam's Club. We know that 60% of U.S. sales are that grocery business. We saw that business increase mid-single digits, as well as Sam's Club's, their membership model hit all-time high, their renewal rates rather. They also boosted up inventory there. And a last final top takeaway here is this ongoing trend that they continue to gain higher income shoppers. This has been going on for years from Walmart, especially post-COVID, as they really doubled down on this idea of making sure that they deliver that value, but also that convenience. We saw Walmart Plus membership income grow double digits during the quarter, and also they've been doubling down on that same day delivery. Ultimately, to compete with Amazon seems to be working here.
All right, Brooke, great stuff. Thanks so much. We are going to continue this conversation, take a look at some of the drop that we're seeing here in Walmart shares. If these losses do hold, we could be looking at the worst day for Walmart stock since November of 2023. We're going to discuss all this with Oliver Chen. He's TD Cowen's senior research analyst. That's coming up right after the opening bell at 9:30 a.m. Eastern time. Well, stock futures set to pull back from record highs after this morning's jobless claims in the Philly Fed survey, adding to a string of some of that weakening econ data. And some market participants out on Wall Street are warning that the recent rally that we have seen, those record highs for the S&P, could actually be due for a pause. Let's talk about what's next. And for that, we want to bring in Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, it's great to have you back here on Yahoo Finance. So talk to me about where you see the market headed. How big of a risk are we at here for some of this momentum to come to a halt?
Yeah, Seana, I think it makes a lot of sense that as we look at the expectations we have in this marketplace, look at earnings. I mean, you're just talking about Walmart earnings. People are expecting another full year of double-digit earnings growth. That's been very supportive of this market and the bull run that we have seen so far. But I do think when we look at the bifurcations that we're seeing, whether it's sectors within the S&P, whether it's triple Qs versus Bitcoin, whether it's S&P and NASDAQ, and how we're seeing relative highs hitting here versus not in the advanced decline line. Lots of bifurcation going on that we've talked about in the consumer, but we're seeing it really flow through to this market. So we wouldn't be surprised to see a 5 to 10% pullback. That doesn't put us into recession, but it does help the market come back and consolidate a little bit around some of these very lofty expectations that are out there. Although earnings have continued to do pretty well, we need to see them hold up in the next few quarters in order to sustain the valuations that we're seeing. And I think that might be a tough call to make.
Which sectors are best positioned from your analysis, even amid some of the bifurcation that's expected?
Yeah, so Brad, I mean, look, we like financials. We've talked about it many times. It's been our favorite sector for a while. And when you look at trend lines, when you look at momentum within the sectors, financials continues to do well. And it's actually had a little bit of a pullback, a little bit of consolidation, but still in an uptrend. So we like financials and think you can continue to add here. You've had a little bit of momentum in healthcare as well. We know that sector has been hit really hard, but perhaps you're starting to see an area where you could tiptoe in to that sector and add. But you're looking at parts of industrials, you're looking at staples, you're looking at utilities. These are really the bifurcated sectors where you have to go in and really do your homework on the fundamentals of the names that are in there and not just do a sector across the board. It really bodes well for active management. It really bodes well for long short portfolios for our clients.
So Victoria, I guess overall then, do you think that the resilience that we have seen in the market, is that justified?
I think it's justified to an extent, and there's probably a little bit more room to go here. We know 70% of our economy is driven by the consumer, and the consumer continues to spend. We've seen that in the consumption numbers. But Seana, look, we saw numbers go up on consumption, but we saw savings numbers come down pretty significantly. We're seeing composite PMIs that are equivalent or correlate to about 1.5 to 2% GDP growth. That's slower than where we are now. So is there a little bit more room to run here? Yes, because earnings are still supportive. But are we seeing things telling us the economy is going to slow down? Yes, we are seeing that as well. So I think you do have to be cautious in where you put your money to work.
Do you think that that will mean sweeping earnings revisions, or will it be selective? What are some of the pillars that you would be looking out for there, especially as we're getting through some of the retail portions and the most consumer sensitive portions of this earnings season?
Right. I mean, you take Walmart as an example, since we saw those earnings today. I mean, that was the shining star for retail last quarter. And now they're even giving pretty conservative guidance for 2026 and talking about even some of the high income consumers starting to spend down and pay less. So I think when you're looking at earnings, I don't think we'll see a sweeping movement across. There's going to be sectors that continue to do well and have support. We talked about financials continuing to do well and other areas starting to come back a little bit. But obviously, you look at Mag 7 names, you look at some of the valuations that we're seeing there, those are starting to pull back. And we have to wonder if the earnings we've been seeing this quarter, Brad, are pulled ahead because of tariffs and other elements that people anticipate over the coming quarters. So I think you'll have selective areas where you see earnings revisions start to come into play, but it should rotate through all of them over the next 12 months.
Victoria, what's your reading on inflation and how big of a threat maybe this could be overall, obviously, to the economy, and then the trickle-down effect here just in terms of how the market should be looking at that risk?
Yeah, it's really interesting because if we look at the move in the 10-year Treasury, a lot of people assumed that was just inflation concerns driving it higher and then seeing it come lower too, having some of that back off. But it mostly was term premium. It wasn't really inflation that was concerning people. We've just started to see 5-year break evens move higher. So that's just starting to come back into the conversation. Is it tariffs that's driving that? I really don't think so. I mean, you can tell over the past couple of weeks, the market and investors are really kind of saying, we're not sure tariffs are going to be something permanent. It's probably a temporary move. And we could see some volatility in expectations, at least in short-term inflation expectations. But I think longer term, those are still pretty well anchored. And even though it's sticky because of housing components, because we've had wages move higher and new labor deals that will continue to see wages over the next couple of years, you will have those sticky components, but I'm not sure we're going to see the huge swings in inflation that some people are anticipating.
Victoria, thanks so much for taking the time here pre-market.
Thanks, guys.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, Palantir shares under pressure on possible cuts and a reported changing coming from CEO Alex Karp. And Alibaba surging as its cloud business surprises to the upside. Details ahead on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at shares of BABA. Alibaba shares, they are rising pre-market after reporting earnings for its December quarter. Alibaba reporting a 13% jump in revenue for its cloud segment. This follows the company's confirmation that it will be partnering with Apple to bring AI to China. CEO Eddie Wu saying in a statement that Alibaba expects, quote, revenue growth at Cloud Intelligence Group driven by AI will continue to accelerate, end quote. Shares are up by about 9.3%. They went on to say that they made some substantial investments trying to spark growth reacceleration in their core businesses, also maintaining some financial discipline, enhanced operational efficiency, and so forth, and also touted some of the results from Taobao and Tmall Group too.
Yeah, certainly. I mean, this really turned into a massive focus on AI, and I think that's really what is driving a lot of the gains that we are seeing this morning, this optimism that we are seeing play out here in the stock. Alibaba saying that they see more cloud growth seen in the next 3 years than they've seen in the last decade, and that was just not even scratching the surface. Eddie Wu also went on to say that it's a once in several decades opportunity. He was saying the pursuit of AGI, which is artificial general intelligence, is Alibaba's primary objective, which is interesting, just given the vastness and given the scale of some of their other businesses. So a real focus and a doubling down on artificial intelligence, on AGI specifically. Alibaba anticipating that if AGI can be fully realized, get this, it can contribute up to 50% of the world's GDP in the future. So again, very, very bullish on the capabilities of AI going forward, those future investment opportunities. And we certainly have seen Alibaba here add to some of those earlier gains, with the stock up now just over 9% ahead of the open.
Yeah, amazingly important here too on the e-commerce side. Let's remember, for all of the social media dominance and transformation that I should say, is moving a lot of customers towards purchasing in-feed. For Alibaba, for some of the Taobao and Tmall type of exposure that they do have, it's important for them to also maintain the amount of merchants that are continuing to use them as the first or go-to first platform for some of their sales here. And they talked about that within the strategic business updates this quarter, adding on 88 VIP members, highest spending consumer group as well, continued to increase by double digits year over year. So trying to bring in even more of the higher tier incomes, seeing some of the value on those platforms. And it comes back to the merchants that they're able to ultimately retain and then grow out that core user base for some of those who are putting their products listed on Alibaba's e-commerce platforms.
All right, let's take a look at Palantir, because shares is selling off once again today, falling after it fell double digits during yesterday's trading session. You're now looking at it off the lows of the session here of the morning, off just about 3.6%. But this also follows CEO Alex Karp's plans to sell up to 9.975 million shares by September. Now, shares also hit by reports that President Trump's Defense Secretary Pete Hegseth is eyeing 8% cuts to the defense budget over the next 5 years. That was the big driver of the stock's most recent move. Now, Palantir has contracts with the Defense Department, but let's put that in context, because I think this is so important just in terms of why Palantir is getting hit harder than many of its peers. And the reason why is that the government actually accounts for 55% of Palantir's total revenue. So much more exposure there to the government side of the business than many of its peers have. And just put in comparison, typically they have mid to high single digits exposure there for the government. So the fact that Palantir's government accounts for 55% of total revenue, that is why we saw such a huge hit on the stock yesterday. That's why we're seeing further declines here today. And also when you just take a look at the recent growth, specifically that we've seen within the government business, more than 40% in the past 2 quarters, obviously showing the fact that they have very much a large exposure to the potential defense cuts.
They do, but and on kind of the two-prong of the story here, one, on the executive package, essentially for Alex Karp to, look, notched some gains here at the end of the day. For the company that he has brought to the market and ultimately been able to see the valuation grow up to this point, I mean, the shares were up. I think even with this move down pre-market, they're probably still higher by about 55% over the course of 2025 alone. So it's been quite the rise to start off the year. You have some of the bulls out there in Dan Ives of Wedbush continuing to say, look, you've had bears essentially calling this out, the exposure to the government, and the bears hating Palantir from $12 to $120 in the last 18 months, and now finding their latest quote-unquote silver bullet negative thesis. However, he continues to argue that this is actually more opportunity and not less for Palantir at a new Department of Defense. That in the note published from Wedbush's Dan Ives here.
Yeah, it's hard to kind of see that being a massive catalyst here for the stock over the longer term, but we'll see. But you're right. I mean, when you take a look at the 1 year chart, you're looking at shares up 350 or so percent here. So again, when you're putting that into context, obviously, then the dramatic moves that we have seen over the last 24 hours or so doesn't look as worrisome as maybe they initially do on the surface.
And to correct myself, I'm sorry, even with this move, essentially we're only up 49% year to date. So didn't want to give you guys 10% extra gains there, but at one point they had, and they have seen new all-time highs over the course of this year. Switching gears here, another company we've been tracking, Nvidia earnings less than a week away, and leading up to the company's results, the street is still cautiously optimistic. Yahoo Finance data shows Nvidia's earnings per share trend drifting slightly lower in the past month. Analyst commentary ahead of the earnings is generally positive, but HSBC did lower its price target, citing pressure on Nvidia in the second half of the fiscal year. Nvidia lost nearly $600 billion in market cap after Chinese rival DeepSeek revealed its AI model earlier this year. You're taking a look at shares of Nvidia. They're still fractionally higher here today, but of course, a lot of that move that we're going to be keeping close tabs on is going into next week. That earnings report, February 26th, and I've been looking at some of the options AI data where it looks like the expected move from this point to post earnings is an expected move either higher or lower of about 8.4%. So that's kind of the general barometer, or perhaps, measuring point that we'll guide up against at this point.
Yeah, and I think that's pretty much in line with what we have seen in most recent quarters. Yes, maybe you can say the street is getting a little bit more cautious, but when you take a look at where these analysts stand in this write-up that we have on yahoofinance.com by Brian Sazi, there's still buy ratings across the board. They are very bullish about the Nvidia story over the longer term, and I think that has been bolstered a little bit by some of the hyperscaler results that we've gotten out over the last several weeks, showing the fact that they remain committed and don't see that shifting anytime soon in terms of some of their spending on AI and the bulk of that spending, what exactly that is going to look like. Bank of America analyst Vivek Arya, he has a $190 price target on the stock, reiterated his buy rating, saying that they do expect a fourth quarter beat. The first quarter outlook, though, could face some headwinds, but looking here past some of that, talking about the fact that they do see momentum in the stock, investors are going to be looking forward to Nvidia's leading new product pipeline, that total addressable market expansion. That is enough here for many of these bulls to remain optimistic about the quarters to come.
And we've been talking about DeepSeek as a detrimental force for Nvidia. There was actually a Macquarie note that mentioned that if the reduction of costs could be seen through some of the competitors like DeepSeek, that could essentially be the catalyst needed for democratization and mass adoption of AI here. And potentially for Nvidia, what that could mean is even if you do have this democratization and a mass adoption of AI and reduction of costs, then there's still going to be more use cases for Nvidia. People are still going to need to buy into chips, and companies are still going to need to build out more data centers. So as much as there was this incremental hit to make the market think about, all right, how much froth is already out there, or how much will new competition disrupt the existing thinking about the entrenchment that some companies have, there still is a potential benefactor play here for Nvidia as well. And I think that's what Macquarie was also noting here. So we'll see how some of the other competitive players certainly disrupt the thinking around the AI trade.
We will. All right, keep right here on Yahoo Finance. We got the opening bell when we come back.
That's a live look at the opening bell on Wall Street and in Midtown Manhattan. At the NASDAQ, you've got Lam Research ringing the opening bell. And at the New York Stock Exchange, you have Columbia Threadneedle Investments ringing the opening bell there. All right, two great bell ringers on both sides. Let's take a look at how the opening cross transpires here on the day. Taking a look at the Dow Jones Industrial Average, we are down right now by about 0.4% to begin today's trading activity. The S&P 500, let's put a chart up there for you just so you could see what the movement has been like over the course of this week. And there we go. As we're taking a look at that move yesterday, that was your all-time high that we were able to notch here. And the larger question is, can we continue to build on that from here? 4.25% higher to start off 2025 here. And let me just put this on a 2-day view so you can kind of see exactly some of the moves that have taken place there for the S&P 500, though fractionally down out the gates this morning. All right, that's not going to populate for me. Let's move on over to the NASDAQ Composite. You had a chance, S&P 500. NASDAQ Composite down by about 0.1% right now. Let's take perhaps a look at the S&P 500 sectors. Let's see if that cooperates. Yes, it does. 11 sectors here up on the screen for you, and we are down across the board. The worst of decliners right now is staples. That's lower by about 1% to start off today's trading activity. Let's take a quick gander at the NASDAQ, as technology is the least of the laggards, if you will. Taking a look at the NASDAQ 100, the tech-heavy average here, we've got 100 of the components there, and Apple, Nvidia, and Microsoft fractionally higher to start off today's trading session. Got a deep decline here on Palantir to start off the activity. It's lower by about 7.9%. And then additionally here, let's just take a quick look at some of those Dow components as we're checking in on our friends here, Walmart, and that's down by about 4.5% post earnings. We've got much more on that conversation with Oliver Chen in just a little bit, so stick around here on Morning Brief. But for a deeper dive into today's early tape, let's get to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Well, thank you, Brad. As you said, S&P 500 coming off a record high. So is the NASDAQ, and this is kind of the way markets behave in a bull market, and that is incremental gains, very slow action. But here's the NASDAQ. You can see it doesn't look like a lot of it is happening over the last 3 months, but we are seeing a breakout. Doesn't look like the S&P wants to cooperate, but we are finally seeing just a slight acceleration out of the trading range. Excuse me, and we have been hitting record highs for a couple days. Bond market and dollar aren't doing too much. Do want to point out that the dollar is actually dropping the most in a week, but not at significant levels. This is a year-to-date price action. You can see going in the right direction for risk assets. And let's skip back over to the sector action. That was a lot of green there. A lot of red there. It looks like healthcare just flashed in the green very briefly. But Walmart leading Staples down. Staples is the worst off here. That is a defensive sector. So is utilities. And then we get into consumer discretionary, the other retail sector. But defensive leading down, and we're not seeing a whole lot of price action return-wise to the downside. Not any dark red, so not too concerning there. Looking over to the NASDAQ, wanted to highlight that we've got more red than green, but the mega caps kind of split themselves, so not seeing a lot of definitive price action here. And let's go over to China. That is a really interesting story. We've been talking about those BABA earnings here, but I just want to show you the big picture. This is a very green board, and I have a lot of the components, not all of them, but a lot of the components of the NASDAQ Golden Dragon China index here. And Alibaba up 11%. That is the best day in several years. That is not even the best performer in this group. We have VNet up 20%, Bilibili up 18%. List goes on. Couple stocks in the red here, but let me just show you what happens when we put the year to date on. We've got one here, Yi up 1,190%. And a lot of people were saying China's uninvestable. There's a decent argument to be made that the government there has been very arbitrary in the way they've treated investors in the capital markets over the years. I get that, but nevertheless, you can't argue with price action. These prices have been screaming higher this year. Want to focus and close with the futures market? I'm going to go back to an intraday look. Here we have natural gas just hit a multi-year high, but then it's selling off. And let me show you the 5-year chart. They call this future the widowmaker just because of in the highly leveraged world of futures. We'll see if we can get the chart up here. Here, that's a 5-year chart, and there's that multi-year high after the decline. Something you definitely want to keep your eye on, because when natural gas prices spike, they tend to go pretty quickly, especially in the upwards direction there. I'm going to leave us with gold, and I'm going to be doing a deep dive on gold in about 30 minutes here. Gold just hit another record high. Let's see if I can find the ticker, GC equals F, up 0.5% today. This is also a 5-year chart, and you can see broke out of the base basically at the beginning of last year, hasn't looked back, and this is, I believe, the 11th record high of the year. Still short of 3,000 though. We'll put up a nice banner when that happens, guys.
All right, Jared, looking forward to that. I'm looking forward to your deep dive there later on this hour. All right, Walmart shares falling more than 5%. It's the biggest drop that we've seen since November of 2023. You're now looking at losses actually of just about 6%. Now the stock under pressure following the retailer's full year guidance that fell short of the street's expectations, and that cautious forecast raising some questions about the resilience of the U.S. consumer. Joining us now, we want to bring in Oliver Chen. He's TD Cowen's a senior research analyst. And Oliver, there is a lot to unpack within these results. Let's just first start with the stock reaction here. You're looking at losses of just about 6% at the open. Is that justified to you?
Well, the big story here is the PE multiple is very high at Walmart. It's 38 times versus a 3-year average of 24 times. So expectations have been very high as the stock's really worked well. What's really happening is the guidance, and people are responding to the guidance. The guidance is a little softer than street expectations. However, we're encouraged that this is conservative and in line with the past in terms of how Walmart guides. And this was a solid quarter, a very stable consumer they're seeing. General merchandise was up low single digits, second quarter in a row for this to happen. Also, general merchandise unit sales were solid, and the comp was better than expected for the quarter. So the stock is weaker on both valuation and guidance. That being said, this company is hitting on all cylinders, including low prices plus technology, digital advertising, and the marketplace model.
Oliver, we know they had something to say about tariffs. We know that you're running the calculus around what this will mean to the business. What is your kind of early estimation about any headwind that could apply to Walmart?
Yeah, part of the guidance is just commenting on this very dynamic environment. So what's going to need to happen is some will be passed through to consumers and some will be eaten by companies in the form of margins. That being said, Walmart is a real leader in rollbacks or discounts or negotiating with suppliers. It also has a more modest percentage of exposure to imports than Target and some others. So those are things that we like, and bigger is better. We think cash is king, and owning these bigger retailers that are executing globally, it's a great place to be.
Oliver, when you take a look at the impact that this is even having on its competitor Target, when you take a look at some of the dollar stores that are lower this morning on the back of these results, I guess, how do you see those spending trends at some of their competitors comparing to this, and whether or not this is a signal maybe of more of that weakness to come?
Yeah, I think we're going to see cautious optimism with lots of cross currents. The story for retail this whole past year has been winners and losers too. And as you think about Walmart, they're executing so well on the supply chain, on curbside pickup, on delivery, on AI. It's really hard for everybody to do this. So they're outpacing others. They're taking share from dollar stores, particularly because Walmart's offering low prices plus lots of convenience. In addition, they're getting higher household income customers. So I think you're going to see winners and losers. It's going to be very difficult for companies to inflect this year, given this cautious optimism, and it won't be winners around the board. We'll see. The consumer still being considered in their purchase, looking for strong values and looking to consolidate, and still focused on needs. A little bit of inflation too, 1 to 2%. It should be normal, hopefully, but some spikes in certain areas like dairy too.
Oliver, you got a lot of people lighting up the Yahoo Finance platform, perhaps using some of those charting tools and looking at moving averages here today, trying to figure out whether or not it's safe to buy Walmart on a pullback like this. What is your evaluation?
We're encouraged. However, I would say as analysts update their estimates overnight, given that it was lower versus street by about 8%, people do have to revise their estimates to this new bar. That being said, this company is consistent and the consumer is consistent. So it's well positioned for a beat and raise, and we certainly like it for the longer term. The other thing to pay attention to, of course, is alternative revenue streams, meaning digital advertising and the marketplace model. As you think about the third-party marketplace, there's only 700 million SKUs at Walmart. There's about 5 billion at Amazon. Also, digital advertising is a big growth opportunity, particularly as the marketplace grows too. That will help margins grow faster than sales. And this retailer has over $9 billion of cash as well. So you're getting a lot of great characteristics, but the near-term estimates need to become a little bit softer. So we'll see.
Oliver, is that going to be enough to offset then some of that weakness if we do see any sort of weakness related to tariffs?
Yeah, I think that tariffs will be something to watch. It's so dynamic, and the consumer and inflation and circular issues in terms of how this pressures consumer confidence. But what we are thinking is there's a real barbell opportunity, meaning we upgraded Cartier and Richemont. We're seeing the wealth effect at the very high end. And then these retailers that can execute to exceptional value, low prices, rollbacks, they will be better positioned because customers will trade down into places like Walmart to get that everyday low price. And that's great across all cohorts. At the same time, you don't even need to go into the Walmart store to experience this. The marketplace, curbside pickup, and those are very expensive operations to run. Walmart's doing it better and better with more profitability on e-commerce. That's another positive too. But it's not a cheap stock, 38 times PE. You can't forget that. We have a buy rating. We like it for the long term, and we like this whole flywheel between technology meets value meets grocery leadership.
What does that mean for the luxury end that you were just talking about a moment ago here? Because you do have a lot of luxury brands trying to figure out how they can go unscathed from tariffs that might hit their business, thinking about some of the European brands, some of the international brands that sell into the U.S. luxury consumer right now, and all the deal making that's also started to take place. Yesterday, we saw two, I think, big deals, at least in my mindset, that are going to change the aisles that people shop in. And Stuart Weitzman going to, what is it, I forget the name. But anyway, some of the big deal making that took place in luxury yesterday as well.
Yeah, Brad, luxury is going through a lot of change. There's a lot of industry consolidation in luxury, so the biggest players are quite large. Our pick here is hard luxury is working, meaning jewelry, gold, and aspects of rings and diamonds. The real beneficiary there is Richemont. The big caution for luxury is China, and China's housing market, as well as this dynamic situation between the U.S. and China, is impacting consumer confidence and spending in the real estate market. The big winner in luxury is the U.S. market, and the wealth effect and the resolution of the election happening added a lot more confidence. That's a nice positive for what we're seeing with spending patterns at the high end. Lots of changes, though, creative changes in terms of at the major fashion houses, and we're still in a bit of a boring, quiet luxury phase where people are yearning for more fashion. So a better picture probably in the back half, but mixed in luxury, you have to be pretty selective. U.S. better, wealth effect, consumer confidence, the last 12 months of S&P 500, those are all positive for the higher end.
Caleres was the word I was trying to remember, Oliver, and Stuart Weitzman, Caleres deal. Yeah, just wanted to clarify that for our viewers. Oliver, it's always a pleasure to grab some time with you and get your analysis. Appreciate it.
Great seeing you both. Thank you.
Likewise. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at jobless claims in the nation's capital. Hey, Maddie.
Hey, Brad, a big question. Is the Dojification of the workforce going to cause some cracks in the labor market that the Federal Reserve is going to have to contend with? One way that we can suss that out is by looking at jobless claims in those states that have the highest proportion of federal workers. Torsten Slot getting us this chart here showing a little bit of an uptick in states like Maryland, Virginia, and D.C. But as of this morning's jobless claims, we actually saw all of those states being decliners on initial jobless claims. So we're seeing this chart, actually, if you continue it out to current levels, moving to the downside here. here. And what's really interesting, I spoke with Claudia Sam about this, talking about this idea that we would have to see a broader sickness in the labor market in order to see some of that Doge cost cutting and firing of federal workers actually impacting the labor market. But one of the bigger questions is, what will company CEOs do when it comes to hiring? Will they put a hold on CapEx for hiring moving forward amid all these questions about the impact of policy? If we see that slowdown in hiring combined with layoffs in federal workers, by the way, made up 35,000 workers in last year's jobs data, could that lead to a broader sickness in the labor market that the Federal Reserve would then have to contend with, guys?
All right, Maddie, thanks so much. Well, coming up, making Meta more accessible to retail investors potentially, why the tech stock could be headed for a potential split. We've got that coming up next on Morning Brief. Meta pulling back after a record 20-day win streak. The recent rally could have some investors start calling for the company to split its stock for the first time since going public. You're looking at a 1-month gain here of just about nearly 15%. We want to bring in Ron Josie. He's Citi's senior analyst of internet equity research. Ron, I'm curious how you're looking at the recent record gains that we've seen in Meta and whether or not maybe it could be headed for a split.
Yeah, split, no split. It's you never know what happens there. I would just tell you from the record gains or the continued growth in the stock, and obviously it's pulled off a little bit last few days. You don't have to look any further than the results, and also where they're investing, and they're investing in significant hardware, software improvements, given all the opportunities within AI. And frankly, they're one of the few companies where we're seeing these investments turn into revenues. And so when we take a step back and split, no split, just from a fundamental perspective, we're seeing advertisers increasingly allocate more spend to Meta. We're seeing, most importantly, usage and engagement grow. And as long as the usage continues to be strong across, whether it be Reels or the feed or stories, or as Meta AI actually gains users, as Threads gains users, all these different platforms, as engagement grows, that creates greater opportunities for advertisers to reach their audience. And I guess at the end of the day, what's driving the move on Meta, and frankly, it's our top pick. It's more advertisers finding more surfaces and being able to really target users and generate that return on ad spend that's needed. And most importantly, not only are we seeing top line growth, but we're also seeing that bottom line hold up pretty well, and that the year of efficiency has continued. We like to say it's a year's or it's still day one on Mark Zuckerberg's year of efficiency.
Interesting, and especially as they're calling it a pivotal year for the metaverse. And so how should we think about all of those elements that you laid out as that relates to what they're prioritizing in this pivotal year for the metaverse?
Yeah, I mean, look, the metaverse, I think, whether it be the metaverse or is it mixed reality or whatever it is, I would just tell you, first and foremost, I think they found a hit on these Meta AI glasses with Ray-Ban Meta glasses. And so, frankly, that's driving a lot more adoption of Meta's hardware, which is really interesting. When you take a step back and you think about the broader business, primarily it is core social, it is engagement, and is monetized via advertising. That's your highest margin that's in the business. And frankly, although they're investing in Reality Labs and the metaverse, I think margins can actually continue to grow within their core family of apps business, which is their core advertising business, as they invest in these newer opportunities. And so whether it's a year of metaverse or not, I think these Meta Ray-Ban glasses are pretty interesting. Regardless, we're seeing greater usage across all of their products that we think can drive greater profitability overall. And that's what really matters here.
Ron, what about the overall AI trade? The fact that it has lost some momentum. There was initially some concern following the developments out of DeepSeek, very much debated. And I think also widely, maybe there is consensus, obviously, that it could be bullish here in the long run. As you look ahead to NVIDIA, not asking specifically about NVIDIA, but how critical are those results to the overall momentum of the AI trade?
Look, I can't really opine on NVIDIA, but I will say that when you think about what Meta is spending on CapEx, whether between that 60 to 65 billion, what Google or Alphabet is spending upwards of 75 billion, what Amazon is likely doing over 105 billion on CapEx, there is a massive investment cycle going on here, given the opportunities within AI. Now, of course, not all of Amazon's 105 billion are related to AI. They do run a pretty interesting, successful e-commerce business. But point being is, the way we're thinking about the internet today and how we interact with apps could absolutely change. And it could change for the better, in that we could see greater engagement because, these apps, and take Meta AI, for example, these agents become more in tune to what we're looking for. And so it's the race to basically win that engagement. And the investments that we're seeing, I don't think they let up anytime soon. And as we take it back to Meta, with 700 million Meta AI users on the path to that billion that I think CEO Zuckerberg's been talking about, that creates a wealth of opportunities that's brand new. It's a new surface that Meta's talking about, new potentially search and other things that come down the pike. So we're in the early days of the AI opportunities here.
Ron, just lastly, while we have you, we got to ask about Carvana as well. Shares taking a hit here on the day post earnings, and the company still did see full year sales hit 416,000. That's up 33% compared to a year ago. What is it that investors are not liking about this report?
Yeah, I mean, look, not only was 2024 a great year, they exited 4Q growing their units 50%. They have 17 plus million monthly unique users. They're becoming more profitable with every single sale that's happening here. And so, look, there's a little bit of focus on what they call the gross profit per unit, which was down sequentially in 4Q. But that, in our view, is mostly seasonality. When we take a step back and think about Carvana, look, the growth in units, in our view, continues to be very, very strong. And as they become the leader, or call it one of the top used car dealers in the US, I think they have a wealth of opportunity to not only continue to gain share, but become more profitable. And frankly, I look at the shares down today on potentially, weaker GPUs, which is gross profit per units, which could be seasonal. I look at it as a buying opportunity.
Yeah, if you ask them, they'll say that they are the most profitable public automotive retailer in the U.S. history as measured by adjusted EBITDA margin. Ron, thanks so much for taking the time here with us today. Appreciate it.
Enjoyed it. Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Birkenstock shares lower after posting first quarter earnings. It was a top and bottom line beat for the footwear company, with revenue growing 19% from a year earlier, but direct to consumer revenue that fell well short of estimates. Shares are down 5%.
United Healthcare offering buyouts to some employees in its benefits unit if they quit by March 3rd. That's according to a report out from CNBC. Now, sources telling CNBC that workers who don't accept will continue in their current role or a comparable position. But if the provider doesn't meet a resignation quota through buyouts, it will then conduct layoffs.
Finally, Grab Holdings, the Southeast Asian ride-hailing and food delivery company, falling after reporting weaker than expected full-year guidance. The company's CFO confirming to Dow Jones the guidance is conservative since it's early in the year. Grab did miss on operating income in the fourth quarter, reporting $2 million versus the $8 million plus that was expected.
Well, that does it for Morning Brief. We keep it right here on Yahoo Finance. We've got Catalyst coming up next.